Canada has quietly pulled off something that is making its economy stronger and giving its oil producers far more power than before. At the same time, America is watching one of its biggest energy advantages slowly disappear, and the consequences are only beginning to show. The Trans Mountain expansion entered commercial service and nearly tripled the capacity of the Trans Mountain pipeline system to 890,000 barrels per day. In the months that followed, the system averaged 82% utilization. Canadian crude oil exports to countries other than the United States more than tripled since TMEP came online. The WCS-WTI price differential, the discount Alberta producers accepted for decades because they had nowhere else to send their oil, narrowed from an average of $18.70 per barrel in the 9 months before the expansion to an average of $12.00 per barrel in the 13 months following its startup. Canada's largest oil pipeline now points west, and the American refineries built specifically to process Alberta heavy crude are competing for supply they used to receive by default. The specific mechanism through which the Trans Mountain expansion changed Alberta's pricing power is documented in the Canada Energy Regulator's market snapshot analysis. Before the expansion, all major oil export pipelines out of Western Canada were running at or near capacity as Canadian oil production reached record levels. Shipper nominations requests to use export capacity significantly exceeded available pipeline space, resulting in apportionment on the Trans Mountain, Enbridge Mainline, and Keystone systems. Apportionment means producers could not ship as much oil as they wanted to, regardless of where the buyer was. The pipeline was the bottleneck. When the bottleneck applied equally to all destinations, American refineries received supply at whatever price the constrained market produced, which included a structural discount for the inconvenience of the constraint. After the TMEP entered service, apportionment on the Trans Mountain system dropped to zero. On the Enbridge Mainline and Keystone, the two major southbound pipelines' apportionment fell significantly, while their utilization remained near capacity. Canada's total oil export pipeline capacity increased by 13% overall, and export capacity to Tidewater in Western Canada increased by approximately 700%. That 700% increase in Tidewater capacity is the structural change that ended the era of Alberta's captive American market. When 700% more oil can reach a Pacific terminal, 700% more of Alberta's production can be loaded onto tankers bound for any buyer in any ocean market without the barrel ever entering American infrastructure. The Westridge Marine Terminal data quantifies the commercial change in specific operational terms. Pre-expansion, Trans Mountain set aside 79,000 barrels per day of capacity for Westridge Marine Terminal service. Post-expansion, Westridge can export up to 630,000 barrels per day of Western Canadian crude. An average of 23 vessel departures per month occurred from Westridge between June 2024 and July 2025, a number that grew to approximately 35 per month by late 2024. Each vessel loading at Westridge is a vessel carrying Alberta crude to Asian buyers, rather than moving it southward into American refinery infrastructure. China became the largest single country buyer of Trans Mountain shipped crude in the first year of the expansion's operation, as reported in May 2025. The crude by rail data provides an additional confirmation of how comprehensively the TMEP resolved Alberta's export constraints. Since TMEP entered service, Canada's crude by rail exports fell to annual average levels not seen in over a decade. Rail is typically used when pipeline infrastructure is not available or when price differentials are wide enough for rail to be economic. The fact that rail exports dropped to decade lows at the same moment the Trans Mountain expansion reached full operation confirms that the expansion provided the market with the incremental export capacity that rail had been partially filling and provided it more efficiently. Rail exports had been a pressure valve for constrained pipeline capacity. They're no longer needed at the volumes that characterize the pre-expansion period. And if you want the real story behind how Canada is still holding its ground through tariffs, wars, and hard times, hit join below to join the membership for exclusive documentaries you won't see anywhere else about Canada's progress and rise through uncertainty. The June 2026 Reuters report on Canadian oil outages and tight inventories at the Cushing, Oklahoma Storage Hub, the physical delivery point for WTI futures contracts, documented what happens to the American oil market when Canadian supply is disrupted or redirected. Weather events and production outages in Alberta reduced the volume of Canadian heavy crude moving south, contributing to inventory tightening at Cushing that affected pricing across the American crude oil market. The episode illustrated in real time that American oil market mechanics remain sensitive to Canadian supply availability. Not because Canada has cut off supply, but because the volume Canada sends south is now calibrated against a genuine commercial alternative in the Pacific market rather than against a captive southbound pipeline system. Trans Mountain settled its tolling dispute with oil shippers on July 7th, 2026. The same day the Ankara NATO summit opened, and one day after Alberta submitted the 1 million barrel per day West Coast pipeline proposal to the Federal Major Projects Office. The tolling settlement addressed commercial uncertainty that had been hanging over the system's long-term contract book since it entered service. Resolved tolls allow shippers to make multi-year transportation commitments with defined cost structures. The commercial foundation that enables long-term take-or-pay contracts rather than month-to-month spot bookings. A system with a settled tolling structure and an 82% average utilization rate is a system whose commercial case for capacity expansion is documented. The Asia-Pacific Foundation's analysis of Canada's oil exporting future describes the structural shift the TMX has initiated in terms of long-term market positioning. China's demand for crude oil imports runs approximately 11 million barrels per day, the largest national crude import volume in the world. Japan and South Korea each import approximately 3 million barrels per day. India has surpassed 5 million barrels per day of crude imports as its refining capacity expands. These are buyers whose combined import demand exceeds 22 million barrels per day, more than 5 times Canada's current total production capacity. The constraint on Canadian crude reaching those buyers was never geological. It was a pipeline. The Trans Mountain expansion removed that constraint at the Pacific Tidewater end. The Carney-Smith Implementation Agreement, signed May 15th, 2026, and the subsequent July 3rd pipeline proposal to the Major Projects Office target 1 million additional barrels per day of Pacific export capacity. The proposed cost range for the new pipeline is 35.2 billion Canadian dollars to 43.7 billion Canadian dollars. If built, the combined Trans Mountain plus new Pipeline Pacific export capacity would approach 1.9 million barrels per day, equivalent to approximately 50% of Alberta's current production. That proportion reaching Tidewater through Canadian infrastructure would mean half of Alberta's output competes in global markets at Brent-linked prices rather than at WTI minus differential pricing governed by American refinery demand. The WCS-WTI differential averaged $12.00 per barrel in the 13 months following the TMEP startup, down from $18.70 per barrel in the 9 months before. Each dollar of that improvement on Alberta's current production of approximately 3.8 million barrels per day represents $3.8 million in additional daily producer revenue, roughly $1.4 billion per year. The American refineries that collected the wider differential for decades by virtue of Alberta's pipeline constraints are now competing with Asian buyers for the same barrels, paying $12.00 per barrel, less than WTI instead of $18.70 less, because the Pacific Pipeline removed the structural leverage that the landlocked discount had previously provided.